Hey, everybody. I am incredibly excited to be coming to you with this episode in particular of Straight Talk Commerce. Um, Number one, it is a subject that I have had many conversations about in the last couple weeks. Had lunch with a very good friend of mine on Wednesday, and he was asking me some questions along this line. I thought, you know what, this would be the perfect time to do this particular subject. And the subject is purchasing an existing e-commerce business. How to do due diligence and find out whether or not it's a good business for you personally to get in. Because if you're thinking of buying a business, before you sign on the dotted line, you need to know the truth behind the numbers, behind the customers, behind legal obligations of that business. Today, I am going deep and I'm giving you the ultimate guide to due diligence so you can make an informed and confident decision on that particular business. By the end of this episode, you should have a very clear checklist of what to audit, what questions to ask, and any hidden red flags that you need to look for. And as a special bonus, at the tail end of this podcast, I have put together a written checklist, a Word document that you can use when you are evaluating any business that you may be thinking of either purchasing or investing in. So if you're ready, I'm ready. Let's get going. Okay. So you've decided that you found this really cool business. You've been presented with this opportunity and you think that the value, or you're curious as to whether or not what they're asking for the business is worth what you're, willing to pay for it, or whether this is an actual business and that you can move forward with. It's very good. It's a very common thing to do. Places like Flippa, there are a number of places where you can purchase online software as a service, whether you can buy all types of physical location businesses or e-commerce businesses. And really, what you're trying to do is figure out whether do the due diligence and figure out that that business is as healthy as the seller claims that it is, and that you're going to face very little resistance when it comes to being able to maintain and make that business thrive. There's any number of reasons why someone would sell. The number one question I get all the time when I would talk about purchasing a business, and I've done this several times, when I would talk to somebody about, oh, I'm thinking about purchasing this business and it's doing this and it's doing X, and they would always say to me, well, if it's doing so well, why in the world would they sell that business? And frankly, that question always, it kind of made me giggle. There's a million reasons why someone wants to purchase a business or why someone would want to sell a successful business. Just for example, the original owner may have passed on and his children may not want to run that business. They have other interests. Their time is occupied elsewhere. So that goes for a brick and mortar business. That goes for a Fortune 500 company. That goes for any type of business. They may want to sell their interest because they have no interest in that business. Local restaurant, very close to me, very popular restaurant, is on the market. And the person that ended up buying that closed the business down because all they wanted was the real estate. But everyone was wondering, why in the world would you sell this restaurant? And that's when we found out that the individual had passed away and that his family was not interested. It was too painful to continue to run that business. So there you go, right there. Number one reason, or a very good reason that someone would want to purchase that, could be health reasons, or sell that business. It could be health reasons. It could be they've lost interest. The passion isn't there for them anymore, or the business climate has changed and they want other opportunities. So there are any number of reasons. We all have our own personal reasons why we go into a business and why and when we punch out. You'll find if you go to Flippa, for example, you'll see a number of businesses all built by the same individual. And there's many individuals that do this, but they like creating a business. That's the juice for them. They like creating that business, getting it to a certain point, and then they sell it off so they can then go and make another business, because that's the part that's fun to them. So the number one thing that you're going to want to figure out when you're auditing a business is you want to audit the customer base. Who is the customer for this business? It's the same exact thing that you do when you start a business on your own. You want to find out great idea if there are customers for it. You need to discuss the importance of understanding who that customer is. Because that's the backbone of the business's revenue. Those are the people that are actually going to pay money for that concern. And without that, you have no business. You're going to dig deep into the analytics, and you are going to figure out the demographics and the purchasing patterns of those customers. You're going to find out where those customers are coming from, how much do those customers spend, how do you gain? That's going to give you an idea on how to gain more customers. Because if you don't know who your customers are, you can't create lookalike audiences. You can't create more customers. If you didn't know what a cake looked like, how in the world would you be able to bake one? It's the same thing. Check for the customer concentration risks. Does one account, is one of your accounts 30% of your entire business? Because that would really give me pause. If a third of my business is tied up in one customer, and then we're talking business to business a lot of times, but look, I've had businesses where certain individuals, I see the same name over and over and over again. And if they ever stopped purchasing from me, that business would feel it. They would definitely feel that. So you want to definitely analyze that. You want to make sure that your business is acquiring new customers that will augment and will build, your business, as opposed to if you're worrying every day about whether or not you're going to lose specific particular customers that are giving you a great deal of your income. You're also going to want to take a deep dive into customer satisfaction and retention, because any business that has a high degree of turnover, you need to know that. It's fine, but you need to know that the turnover on this business is incredible, because those things are going to factor into creating new business. You're going to want to know, hey, look, I'm very heavy when it comes to customer acquisition. I'm going to need to budget accordingly, and make sure that you understand that from the very beginning. So remember, if you're buying a customer base, you're buying their trust, and make sure that trust is solid. You want to make sure that you have a very good relationship, or this business anyway, before you purchase it, has a very good trust factor with their customers, because if not, it is definitely going to affect the value of the business. It will definitely affect what I would pay for a business. If I had to go in and fix those things, that's going to affect how much I'm going to be willing to pay for that business. You want to check for potential legal pitfalls. You want to make sure that you can find out about pending lawsuits or disputes. And that does not mean asking the current owner whether anyone is suing him right now. That means maybe a trip to the local courthouse or to the state attorney general and find out whether there is pending litigation against this company. It is not it's not a game ender, but it is certainly something that you are going to want to know, because those things need to be settled before I purchase any type of business from someone. I don't want legal problems hanging over my head on something that I've just purchased. So I am definitely going to want to make sure that I know that. I'm also going to take a look at any intellectual property rights and potential infringements that I am purchasing. So if I am selling a product, I'm about to buy a company, they're selling a product that is very similar to other products. I'm going to want to know when I purchase this business, that I'm protected. I have the patents or I have permission to sell those products. Got it? You cannot go and just wing that. These are questions that you have to actually ask, and it needs to be answered to your satisfaction. Don't get excited. This is not the time to get all excited. There's many a slip between a cup and a lip. So, but from the time that you decide, hey, I'm interested in purchasing this, there's a million questions that you need to ask before you sign on the dotted line.
If your
You
business operations feel like a grind, you're missing out on the magic of artificial intelligence. Whether you're in retail, manufacturing, finance, or any other industry, AI is a game changer. From automating mundane tasks to optimizing your supply chain, AI can transform how you operate. We specialize in creating tailored AI solutions that meet your unique challenges and goals. With our expertise, you can improve efficiency, reduce errors, and make better decisions. Discover how AI can revolutionize your business. Contact us today at www.toolessentials.ai/consultation.
You also, if there are employees, you definitely want to take a look at any employees, all, not any. You want to take a look at all employees. You want to take a look at their contracts and the company's liabilities to that employee. If you buy a business only to find out later on that your best employee has a contract that you don't want to satisfy, it's too late. If you find out that you have an employee that knows the whole thing and there's nothing in place that keeps that employee from leaving you and going and being your direct competitor, you've just spent a great deal of money for a massive headache, and you really don't want to do that. So you want to make sure that you get all of those questions answered well in advance of you ever signing anything over. You also want to make sure that your employees are not going to quit you the minute that you walk in. And I'm looking at Elon Musk. When Elon came in and bought X, he bought Twitter, came in carrying the kitchen sink. He basically knew that the employee turnover was going to be fast and furious because it's one of the reasons that he purchased it. But he knew that going in. It didn't stop him from purchasing Twitter. What it did was he asked the questions, he got the answers that he needed, and he factored that into whether or not he was going to actually purchase it. What you want to see is copies of any legal documents. You want to see any contracts. You want to see any agreements that they have made. You want to see all licenses that pertain, right, to the business. You want to see a history of lawsuits and what the outcomes of those lawsuits were, by the way. If you constantly are if it's a coin flip of whether or not you're going to win a lawsuit against you, maybe you back off a little bit, or maybe you reduce what you're willing to pay for that company. But if you have a history of people that are suing you, or through no fault of their own, but they constantly lose, that gives me a heck of a lot more confidence that I am in a rock solid situation where people have tested me. They have tested this business, and I'm not going to end up sitting there holding an empty bag at the end of the day. You want to see evidence of any compliance issues with industry regulations. You want to engage if you can. And even I would not make a major purchase like this without engaging in a business attorney that's going to help me be right next to me while I'm scrutinizing any legal aspects of owning a business that I'm getting ready to purchase. The money that you spend up front is going to save you in the long run every single time. No exceptions. No exceptions. You hear stories all the time about some entrepreneur buying a business, and the only thing that they bought was they inherited lawsuits that they were not even aware of. Do not let that be you. It happens a lot. And it's not pretty, and you end up burning through money that could have been spent building this business. Okay, let's talk about verifying earnings. Because they always, a business owner wants to put his best foot forward. And there's a number of ways of people coming up with the value of their business. There's at least two different ways that Wharton Business School recognizes. We're going to talk a little bit about those. But, what a business is valued depends on what perspective you're looking at. But no business is worth more than what you will pay for it. Do you understand that? Let me say that again. No business is worth more than what you would pay for that business. Um, the importance of validating revenue and profit and the ease in which that comes, it can be very easy. It can also be a little more difficult when it comes to that. So, what I'm about to say is not every single time, but these are the things that you definitely want to make sure that you are verifying from a third party source, by the way. In other words, you can walk into someone's business. You're sitting at a conference table. They have laid out their books in front of you. Take in that information. That's great. However, you need a third party to verify what that business is representing to you. In other words, going to the bank and having access to the bank's opinion of what the money is. I wouldn't do it without that. In other words, I want to see the bank statements from the bank, not your bank statements that you are presenting to me. Okay? Request audited financial statements for the past 3 to 5 years. That's going to give you a pretty good, it's going to give you an idea of the history of the company. Compare the reported revenue with whatever tax filings they have. And a good tax attorney, if you're already working with someone or whoever prepares your taxes, they may be able to step in and help you here. Again, these are things that are must do's. Do not spend hundreds of thousands of dollars, millions of dollars on purchasing a business that is only going to blow up in your face. You're going to lose the money that you already put out there, and for no good reason. So you need to pay very close attention to this. You need to be able to identify one-time earnings versus reoccurring income or recurring income. In other words, do we have contracts in place with this business? Or are these one-time shoppers that I am purchasing from you? Or is it a combination of both? Let me give you an example. I was looking at purchasing a watch company in Florida, $4 million in annual sales. Most of that $4 million in annual sales came from one source. And that's kind of what freaked me out about it and made me back off purchasing the watch company. It was a luxury brand, and I sat there thinking to myself, man, if something happened to that revenue stream, I don't know what I would be able to do. Anything could happen to that. And I don't like putting my company at risk or my money at that amount of risk. Now, look, it could have worked out just fine for somebody else. It was just not something I was ready to do. Look for sudden spikes or drops in earnings. So when you're looking at that 3 to 5 years, when you're looking at the history of this company, you want to take measure of any sudden spike or any drop in earnings, because that's going to tell you a lot about where that money came from. If you're comfortable with it, if it's easily explained, or even if it's hard to explain, but you're satisfied with the explanation of those spikes, those valleys, because all businesses go through that, then it's clean bill of health. That's not a problem. But you want to be aware of them, and you want to know where they came from and why. What was the reason that October through December, you had this massive dip in revenue? Let me give you an example of this. Spirit Halloween stores. They only operate for about 3 months a year. They operate all year round, but the stores are only operating and earning income for 3 months out of the year. Does that mean that you shouldn't purchase that business? It does not mean that, because they make a ton of money during that 3-month period of time. But all of their expenses, or most of their expenses, go from January until September. They're very low. And then come October, through December. Now you've got these, this massive spike in all of those things. So it's a very good explanation of why it's a Halloween store, right? It's a very good explanation. And so but it's something that you need to know. You also want to know about any unexplained or excessive expenses. Where did those expenses, did we incur those expenses? Where did those expenses go? And should I be preparing for this in the future? Maybe it was a one-time expense. They bought a piece of equipment and they won't have to do that anymore. And now they're taking depreciation off of all of those things. And they will not have to do that again for another 10 years or so. That's great. That's good news. But if it's not explained, you have no idea where these expenses came from, or it's a very kind of wishy-washy explanation, radar goes up a little bit. Hire a forensic accountant to validate the earnings. A second pair of eyes can really catch what you may miss. And again, do not take the company that you're purchasing, do not take their word for any of this. You want third party to verify what it is they're telling you. In other words, you want to talk to their customers. You want to talk to their, as if you can. If you can talk to their customers, because sometimes maybe you don't want their customers to know that you're about to purchase them. So you want to be careful around that as well. You want to make sure that you're, talking to the right people. You want to get a very confident flavor of what's going on with this company. Let's talk about company value, or valuing a company. This is a very difficult thing for some people, because it's an emotional decision. You've got somebody that's been running a business for 10 years. They think that their company is worth X amount of dollars. You take a look at their spreadsheets and their customers, and you are more pragmatic because you want to spend as little for that business as you possibly can. And there are two different ways of determining what the true value or accepted value of a company is. We're going to go over a couple of different ways commonly companies are valued, valuation methods. And one of them is called EBITDA. It's earnings before interest, taxes, depreciation, or amortization. Let me explain that a little bit, okay? So what you're looking at is their earnings before interest, taxes, depreciation, or amortization. So you're looking at purely the earnings of that company to determine their value. It's not really I don't think that that's a very good way of looking at it. I think holistically, you should be looking at everything before you decide to determine what the value is. And by the way, the value to you for a business is going to be every single time different than the value to me. Because you may have a passion. You may see a business that you really want to get your hands on. You know in your heart that you can do a better job of everybody else on running that business, and you already have a plan in place of what you would do. So that needs to be taken into consideration as well. But you want to apply an industry standard multiple to the EBITDA. And for example, 3 to 5x for small businesses, but only in certain sectors. And I know that that's going to sound very confusing. So I would love for you to, this part of this, I want you to, Google is going to be your friends. AI is going to be your friend. Because if you don't understand what I am saying right now, you definitely need to get an understanding. And I'm probably going to make a decision on the fly to kind of gloss over this a little bit, because it does get a little bit confusing. Don't want to be misquoted. But let me give you an example. A business with an EBITDA of 500,000 with a 4x multiple would have a valuation of $2 million. In other words, $500,000 in earnings before interest, taxes, depreciation, and amortization, but you also want to give them a 4x multiplier on that because of that, and that's how you would figure out what the value is. However, that goes out the window when you have someone that is emotionally attached to their business. They're probably going to ask for 2.5, 3, $4 million. That's the value of it to them. So you must consider when you're valuing a company, how much would that person sell it to you for versus how much are you specifically willing to purchase this company for. So I want you to understand that we represent that, we respect that. Calculate the net interest and the net asset value by adding the business's tangible and intangible assets and then subtract the liabilities. That's actually a better method of getting this done. Let me repeat it. Take the asset value, whatever the company, the asset, the customers, the amount of interest, the amount of the loans, all of that. But you sum up the business's tangible and intangible assets and then subtract any liabilities out of that. That is going to give you the value. Now, that method is commonly used for asset heavy businesses or a tremendous amount of inventory. So with e-commerce, it's a little bit different than trying to do that for an e-commerce business. But if you're going to buy a company to liquidate it, that is definitely something that you're going to, a method that is going to be critical to you. You're going to really want to dig into that method. So let me go over it again. It's commonly used for asset heavy businesses or when the liquidation value is critical. You want to take the net assets, everything that company owns, and then take both tangible and intangible, and then you want to subtract out of it, suss out of it any liabilities. That's going to give you the value. An example of that would be if the total assets are 1.2 mil, liabilities are $500,000. The total value of that company would be around $700,000, give or take a little bit. Again, finding someone or getting someone that is going to sell at that. And by the way, maybe you if somebody's in that kind of trouble, you're going to be able to get a little bit of a discount on that $700,000 as well. So see, again, this is a little bit of a flux. But let's take a look at valuation red flags. You want to make sure that you are looking at any overinflated projections, you want to be able to explain any projection on income over the next period of time. So you have the spreadsheet sitting in front of you and somebody says we made 1.2 this year, but we expect 3.5 next year. You're going to say, okay, tell me why. Why do you expect this tripling of what you did this year? You also want to take a look at dependence on a single revenue stream. So if you have a company that is, let's say a survival store, for example, and you have a outdoor company that is purchasing a lot of your product, if something happens to that relationship and it's 1/3 of your income, you definitely want to pay attention to that. You want to make sure that those relationships, A, are rock solid, and B, there is a plan in place to reproduce customers like that. And you also want to find out whether there are any hidden debts or any liabilities that have not shown up on the balance sheet yet, because that is definitely something that you're going to want to know. Did you know that many businesses are overpriced by 20 to 30%? Just because of the owner's emotional attachment. So, listen, that's not my own opinion. I think it's a little bit more than that, but that is a widespread belief that just take 20 to 30% in your brain, take 20-30% of the business's value off because it's overpriced, because you have a owner that is emotionally involved, emotionally attached to that company. And there's really no way to kind of separate that. Rightfully, a lot of these companies, they're rightfully proud of what it is they've built. Here's some additional key areas of due diligence. Operational considerations. Assess the supply chain and the vendor relationships. We've talked about that a little bit before. Also assess your knowledge about that industry. Is this going to be a learning curve? Are you going to have to request that the owner, the current owner, stay with the company for a little while you get your feet wet and you understand what is all going on? Or are you an expert in this subject matter in this particular business? And that's why you want to acquire the company in the first place, because you think you could do so much better than the current ownership. Those are things that you want to definitely take into consideration. Evaluate the strength of the management team. Meet with everybody that's involved. Figure out who's staying, who's going. There may be personality conflicts you don't even know about yet. You're going to be inheriting. You need to take that into consideration prior to purchasing the company.
ToolEssential.ai is an innovative platform designed to streamline and optimize workflow automation for businesses of all sizes. Integrating seamlessly with your existing tools and systems, ToolEssential.ai leverages advanced AI to automate repetitive tasks, enhance productivity, and reduce human error. Our platform offers customized solutions tailored to your industry needs, empowering your team to focus on strategic, high-value activities. With ToolEssential.ai, you gain real-time insights, improve operational efficiency, and achieve faster, more impactful results, ultimately driving your business growth and success. Experience the future of work with ToolEssential.ai.
And post-purchase, you need to figure out a transition plan. What, if any, will be the transition plan between you handing me the keys and your exit? Because there could be months or years between those two events. Sometimes you purchase a company and that person leaves next day. Sometimes you're going to need the key performers of that business to stay with you. And you are also going to need to make sure that they don't compete with you, especially initially when it comes to running that business. You do not want someone that is going to come in and immediately when they leave, go and start their own business that is going to directly compete with you. That's silly. Create a roadmap for integrating or improving operations. So come in with a plan of what you would like to do. Now, word of caution, I would do that on slowly, because one of the things you want to take into consideration, people don't like change. So if you come in and day one decide, and it's your business, you can do what you want, but on day one, you start changing everything about the way that they currently do business, it's probably not going to go over as well as you think it will, and you should care about that if you don't. Very rarely is the best idea to come in and completely rip apart the management team, completely rip apart and tear apart the employees of a company. They become very discouraged extremely quickly. Don't ask me how I know this. And you are definitely not going, why cause yourself, you're the owner now, why cause yourself that harm? All right. So now we have talked about, all of the different things. Let's go a little bit of a review. Okay. Your customers, before you purchase a business, you need to make sure that you understand where the customers for that business, where they're coming from. You need to do a checklist, make a checklist, or use the checklist that I'm giving you at the end of this, and audit that entire business from A to B. You want to understand where the customers are coming from. You want to understand what they love about this company. Do you understand what the company does wrong when it comes to their customers? You want to make sure that you understand all of those things and that you have an answer for all of those things. Your customers are the most important part of any business. Make no mistake about it. The ownership, the management team, the employees mean nothing without the customers. So they are the primary focus. And if you can't figure out where those customers came from, then you are not going to have a business in the future. If you do not understand and have a very good idea of what the customers like about your product, you cannot make it better. If you cannot understand what they don't like about your product, how are you going to improve? You have no roadmap sitting in front of you on how to improve. So those things matter. Audit that first. Figure out exactly that, or make sure that you understand exactly who the customer for that business is. Analyze the customer demographics and their purchasing patterns. Check for customer concentration risk. Make sure that it's not a West Coast only business or an East Coast only business. And if it is, that you have a plan to expand other areas. You want to make sure that you've got a nice milieu of customers. And you want to make sure that you understand why, if any, high churn rates there are, or if there's a sudden decrease or increase in customer acquisition. You want to be on top of that. You want to understand, hey, we're about to get an entire influx of new customers, and you want to make sure that you can accommodate those customers, and you want to understand where did they come from, because it makes it a lot easier to find that again, find more of those. You want to find out whether there are any pending complaints or disputes from your customers as well, any litigation, any legal problems. You want to make sure that you've got your hand on that and that you are safe when it comes to, any legal issues that are coming up. You want to take a look at any past lawsuits. How did they? What was the issue? How did they resolve themselves? Was it a massive payoff with this company, or did we win a great deal of money because of that? You want to take a look at any disputes, not just the lawsuits themselves, but let's take a look at any disputes that may turn into lawsuits in the future. You want to take a look at your intellectual property rights and your potential for infringing on someone else's, or the feeling that you've infringed on their intellectual property. You want to take a look at any employee contracts, any liabilities. You want copies of all legal documents, any contracts, any agreements, any licenses that this company needs to possess. Make sure that you're licensed to do business where you're actually doing business. Again, a history of lawsuits and the outcomes of those lawsuits. You want to make sure that you've got them in your hand and you've read through them. You've engaged a specialized business attorney to scrutinize all of these legal things, because they will sink your ship before you ever get out of harbor if you don't. You want to take a look at your revenue and profit, any claims by this company that they made a certain amount of money per month, per year, per quarter. You want to make sure that you verify those third party. You want to go to the bank. You want to have them come with you, go to the bank, and make sure that the IRS and their bank that they're doing business with, or Stripe or PayPal or American Express or whoever their payment portals are, verify the numbers that you are being given by this particular company. You want to request audited financial statements for the last at least 3 to 5 years, just to make sure that they match up with what is reality. Make sure that it's an actual real thing. You want to identify any one-time, any recurring income. Make sure that you know that those events actually took place. And you want to explain any unexplained or excessive expenses. There have been a lot of times, you guys, when someone is going to sell their business, only then did they realize that someone in their midst was embezzling funds from that business. They didn't know before. They operated for 10 years and did not know that someone was embezzling funds until they went to sell themselves. And that's how it was discovered. So don't be shy when you're asking about these things from the owner, because you're doing them a favor as well. Number one, you're potentially buying their business. Number two, you're also going to help them uncover any malfeasance going on in their business. At the end of this, you both should be on better and firmer foundation. This does not have to be antagonistic, and it shouldn't be antagonistic. You should be treated with respect, but you should be treating them with respect as well. You need to be able to use at least one or two methods of determining fair value of the company. You want to pay the owner of the company what their company is truly worth. You don't want to get suckered into paying them an emotional fee because they've decided to sell their business. That's all I'm saying here. There's a number of methods of uh, of calculating value. Both of them need to be taken into consideration. I'm going to leave you to discovering better what they are. I'm not going to go back over what I just covered. I can picture a bunch of people glassy eyed the last time that I tried to do that. But you need to take into consideration when you're purchasing someone's business, their feelings. You're going to get the best deal if they know that you respect what it is they've done and not go in and tell them, hey, your business isn't worth this, what they're asking. You say, hey, I understand that you feel that it's worth $2 million. Here's where I am, and here's where I am, what I'm willing to pay for what the work you've done. That's a much better way of going about this. You want to make sure on valuation red flags, you want to make sure that the profits are not overinflated, that their projections for the new years or for the future are not overinflated. You want to make sure that the dependence on a single revenue stream is well accounted for. Or that there are multiple revenue streams from a business. That's another good reason for you to purchase a business, by the way, especially if you think you can add value and make other revenue streams in that same business. I see businesses every single day that I don't believe are maximizing their revenue streams. It happens. I talk to David Layton all the time about this. I talk to Frank Buchanan all the time about this. I see so many businesses out there that are not operating at what I would consider my peak efficiency when it comes to that. So keep that in mind. When you're going through all of this, say, hey, what other revenue streams could this business currently be making available to themselves that they're not currently? Because maybe that does increase the value in your head. Maybe you do think, oh, wait a minute, it is worth more because I will be able to, with what they've already done, I will be able to increase the value myself of this business. It is worth that to me.
If your business operations feel like a grind, you're missing out on the magic of artificial intelligence. Whether you're in retail, manufacturing, finance, or any other industry, AI is a game changer. From automating mundane tasks to optimizing your supply chain, AI can transform how you operate. We specialize in creating tailored AI solutions that meet your unique challenges and goals. With our expertise, you can improve efficiency, reduce errors, and make better decisions. Discover how AI can revolutionize your business. Contact us today at www.toolessentials.ai/consultation.
You want to assess the supply chain and any vendor relationships. You want to evaluate the strength of the management team of that business. You want to make sure that that business aligns with your values and your expertise. Listen, purchasing a business and then finding out later on they do things that are misaligned with your values, that is a horrible. I can't imagine too many things that would be worse than that. You purchase a company, come to find out they make lasers to put on the heads of sharks or something. I don't know, but I mean they do something that you find absolutely, and a lot of their income comes from doing something that you find personally offensive. But now it's too late because you've already bought the business. Now you're doing something that you find offensive. Happens, you guys. It happens a lot. Make sure that the business aligns with your values and expertise. Create a roadmap for integrating, improving operations. Talk to the current management team and employees. Get from them what did they think? What would make them work harder for you than they did for the current owner? I've created a downloadable checklist that I'm going to put in the description of this video. I am also going to take that same checklist and put it at the end of this video on video. So you can just go through and write it down if you want without downloading my Word document. And it's going to really help and give you a little bit of a cheat sheet when it comes to auditing a business that you yourself are either looking to get into or looking to purchase for yourself. And look, that's totally free. I love doing this kind of thing. I am so excited that I get every week to come and talk to you guys, and our audience is growing exponentially. I think by Saturday, this is Friday now, I think by Saturday evening, we'll be over 20,000 subscribers, you guys, which to me is mind boggling. And it's very cool to think about what's going to happen here um, in the future, the things that we'll be able to do. I've got some live events that I'm currently planning. Um, a little bit of a hiccup. You notice that the difference in Straight Talk Commerce. I think it's for the best. We'll see. We'll see how that goes. But anyway, if you have a question, if you have a comment, you know where to put those things. Give this video, if you found value in it, a big thumbs up. Give it a thumbs down if you'd like, if I didn't cover the things that you wanted to cover. The only way, you guys, the only way that I am able to make each of these better than the last one is through your comments and suggestions. You are just as big a part of this as I am. So I am asking you, comment on this episode, like it, subscribe to it so you get more of this content, and help me steer this into the topics that you would like to talk about next. Look, that's all from me. Until next week, have a great one.